Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I will continue a new thing I'm trying for 2025. If you comment on this or other videos that come out in March, I will put you in a draw for a 1-hour one-on-one mentoring video call with me, a $50 value. We can look at your portfolio, talk about financial independence, personal finance, retirement, whatever you'd like. So comment below. Up to 5 entries are allowed, one per March video. I had a question about covered calls and credit spreads. So let's talk about options, but let's do a quick recap of options first so everyone has the context, and then cover the strategies for puts, calls, and credit and debit spreads as the question asks. This video will be an introduction to options and options trading. So let's take a look at the building blocks, the puts and calls. Put options. A put option is a financial contract that gives the buyer the right, but not the obligation, to sell a specified quantity of an underlying asset, such as a stock, bond, or commodities, at a predetermined price, called the strike price, within a specified time frame until expiration date. The seller or writer of the put option is obligated to buy the underlying asset at the strike price if the buyer chooses to exercise the option. Let's take a look at the key components of a put option. One is the underlying asset. So the asset that the option contract is based on. It'll be a particular stock, for example. Number two is the strike price, the price at which the buyer can sell the underlying asset if they exercise the option. Number three is the expiration date, the date by which the option must be exercised or it expires worthless. And number four is the premium. That's the price paid by the buyer to the seller for the option contract. One of options is a call option. A call option is a financial contract that gives the buyer the right, but not the obligation, to purchase a specified quantity of an underlying asset, such as stock, bond, or commodity, at a predetermined price called the strike price, within a specified time frame until the expiration date. The seller or writer of the call option is obligated to sell the underlying asset at the strike price if the buyer chooses to exercise the option. And then we have the key components of a call option, which is number one, the underlying asset, once again, a stock. Number two is the strike price at which the buyer can purchase the underlying asset if they exercise the option. And number three is the expiration date by which the option must be exercised or it expires worthless. And lastly is the premium, which is the price paid by the buyer to the seller for the option contract. So to summarize, calls are an option to purchase, while a put is an option to sell. Now that we know the building blocks, let's look at some strategies. The first strategy I'd like to cover is the cash covered put. A cash covered put, also known as a cash secured put, is an options trading strategy where the investor sells or writes a put option while simultaneously setting aside enough cash to purchase the underlying asset if the option is exercised. This strategy is typically used when the investor is willing to buy the underlying stock at a lower price and wants to generate income from the premium received by selling the put. Here's how it works. Number one, you're selling the put option. So the investor sells a put option, giving the buyer the right, but not the obligation, to sell the underlying stock at a predetermined price or strike price by a specific expiration date. Number two, they set aside the cash. The investor sets aside enough cash to cover the potential purchase of the stock if the option is exercised. This ensures that the investor can fulfill their obligation to buy the stock at the strike price if the buyer chooses to exercise the option. Having access to the cash via a margin account is the way most people, including myself, do this. This way, if I don't receive the stock, I don't have to have the money on hand, and there's no opportunity cost to having the cash sitting idle. Also, arguably, if I don't have any cash and just collect the premium, I made the premium off of nothing, leading to an infinite percent return on investment. Number 3, I'm earning a premium income. The investor receives a premium for selling the put option, which provides income upfront. If the stock's price stays above the strike price, the option will likely expire worthless, allowing the investor to keep the premium as a profit. And number 4, you get the potential purchase of stock. If the stock's price falls below the strike price, the option may be exercised and the investor must buy the stock at the strike price. Because the investor has set aside enough cash to cover this potential purchase, this is why the strategy is called cash secured. This strategy is best for investors who are bullish on a stock's long-term prospects and are comfortable with the possibility of owning the stock if the option is exercised. This is what I do most of the time with options, to make extra cash and to occasionally acquire stock at a cheaper price than I would have bought anyway. The average returns are in the double-digit range when annualized, and if I am correct in the share price going up, I keep making premiums without ever having to come up with any cash. I exclusively do this on stock that I already own, so I am familiar with it. I would want more of it. And if the price goes up and the option expires worthless and I don't receive any more stock, I am benefiting in the price going up on my existing shares. The second strategy we will cover is covered calls, no pun intended. A covered call is an option strategy where an investor holds a long position in an asset, like a stock, and sells call options on the same asset that they already own. This strategy is used to generate income through the premiums received from selling the call options. The investor's long position in the asset, quote unquote, covers the call option, meaning they can deliver the shares if the buyer of the call option chooses to exercise it. This strategy is ideal for investors who believe the underlying asset's price will not move significantly in the near term. Here's a breakdown of how it works. Number 1, you're holding the asset, so the investor owns the underlying asset, such as a stock. They sell the call option. The investor sells a call option on the same asset they hold. This gives the buyer of the call option the right, but not the obligation, to buy the asset at a predetermined price, the strike price, by a specific expiration date. Number 3, they're receiving the premium. So the investor receives a premium from selling the call option, which provides immediate income. Now here's the potential outcomes. If the asset's price remains below the strike price, the call option will likely expire worthless and the investor keeps the premium and the asset. If the asset's price rises above the strike price, the buyer of the call option may exercise the option and the investor must sell the asset at the strike price. In this case, the investor keeps the premium but may miss out on further gains if the asset's price continues to rise. This is one of the problems with covered call ETFs, is that you miss out on any upside past the strike price that the ETF sets on the stocks that the ETF owns. Let's take a look at some benefits and risks of covered calls. First, the benefits. It generates additional income through premiums received. It provides a partial hedge against the decline in the asset's price, where the premium is helping you as the asset's price goes down. I personally use the wheel strategy, where I sell puts until I get the stock and then sell covered calls until I lose the stock, collecting premium along the way, all double-digit annualized returns, all by virtue of having access to cash. Next, some risks. Well, the covered call limits the potential upside if the asset's price rises significantly. The investor still faces the downside risk if the asset's price declines significantly, although the premium is helping offset some of those declines. So for an example, if you own 100 shares of a company currently trading at $57 per share, you sell a call option with a strike price of 60, expiring in 1 month, and receive a premium of $2 per share. If the stock price remains below 60, you keep the premium and the shares. If the stock price rises above 60, you may need to sell your shares at the strike price, but you still keep the premium. Let's move on now to more sophisticated and complicated strategies using two options at once, the credit spreads the original question asked about. Note that these are generally used by options traders without actual shares being involved. The trader doesn't want to hold shares because they're costly and don't have the multiplier that the options do. So first is the credit spreads. A credit spread is an option strategy where an investor simultaneously sells one option and buys another option with the same expiration date but different strike prices. The premium received from selling the option is higher than the premium paid for buying the other option because the sold option was closer to the money, the current stock price, resulting in a net credit to the investor's account. They have money in their pocket. The purchased option is being used to offset the risk of a significant price move in the underlying shares, where the trader is willing to pay for the insurance against a big price move. The trader is hoping both options expire worthless, meaning out of the money, and there are two types of credit spreads. The call credit spread, also called a bear call spread, involves selling a call option at a lower strike price and buying another call option at a higher strike price. This strategy is bearish, and the profits when the stock price decreases. The further out call was purchased to start benefiting if the shares go up significantly to stop the trader from missing out on share appreciation past a certain point. The second credit spread is a put credit spread, also called a bull put spread. It involves a put option at a higher strike price and buying another put option at a lower strike price. This strategy is bullish and profits when the stock price increases. The further down put was purchased to start benefiting if the shares go down significantly to stop the trader from being penalized by the shares dropping. The second type of spread is a debit spread. A debit spread is an option strategy where an investor simultaneously buys one option and sells another option with the same expiration date but a different strike price. The premium paid for buying the option is higher than the premium received for selling the option because the bought option is closer to the money, the current stock price, resulting in a net debit to the investor's account. So the investor is out of pocket. The sold option is further from the money, the current stock price, and is being used to offset the purchase price of the purchased option. The trader thinks there is only a small chance that the share price will reach the strike price of the purchased further out option. The trader is hoping the share price goes past the strike price of the option they bought, but not as far as the strike price of the option they sold. There are two types of debit spreads. The call debit spread, also called a bull call spread, and this involves buying a call option at a lower strike price and selling another call option at a higher strike price. This strategy is bullish and profits when the stock price increases. The strategy stops profiting once the stock reaches the strike price of the option the trader sold. And then the second debit spread is a put debit spread, also called a bear put spread, which involves buying a put option at a higher strike price and selling another put option at a lower strike price. This strategy is bearish and profits when the stock price decreases. The strategy stops profiting once the stock price falls past the strike price of the option the trader sold. That was a quick overview of options and the strategies. There are many, many more complex strategies where the trader is able to make money off any type of movement of the underlying stock. If they are right, the number of possibilities, I almost said options, are endless, leading to some complicated profit-loss graphs like the Iron Condor. So let me know if you use cash generating options or options trading in your strategy, and to enter the draw for the one-on-one mentoring for March. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.